Let's do an exercise. We're going to evaluate an offer. You're buying new living room furniture. The cash price is $799.95. Sound familiar? It's $800. The salesman explains that you can pay as little as $80 down plus $3 a day for 1 year. This type of offer almost always costs you more while generating more profits for the seller. The only way to know for sure is to do the math. If we take $3 times 365 days, that's $1,095, plus the original $80 down is a total price of $1,175. Which one looks better now? The finance price is $375 more than the cash price, and that $375 is nearly half the $800 price of the item we're financing. The important thing is that we overcome our natural impulse to go for the offer that sounds good. We do that by doing the arithmetic and thinking about whether or not the item we're buying is a good use of credit. We've just looked at how interest rates and the length of the loan affect what we pay for credit, and we know that we should always do the arithmetic on offers that sound good. There are more types of credit that we can go over in this video, but let's go over a few of the main types.
Installment loans, like car loans and standard mortgages, are for a set fixed amount. Interest is added, and the total is divided over the length of the loan so the payments are equal. Installment loans can be secured or unsecured. A secured loan is one where the item being financed has a lien on it, securing your payment. Vehicle finances and mortgages are secured loans because if the borrowers don't live up to the contract terms, the lender can repossess or foreclose. An unsecured loan has no property or collateral securing the loan's repayment. Because unsecured loans carry more of a risk for the lender, they usually cost more in interest or require a higher level of credit worthiness. Revolving credit is credit that allows you to borrow as much or as little as you need at any given time, up to a preset limit. Credit cards are the most common example of revolving credit. When you pay off your balance, your credit revolves back up to your limit. Revolving credit usually comes at a higher interest rate than an installment loan, and the interest is calculated differently and according to the particular contract. There are many other types of credit, including service credit from utility companies and leases for apartments or vehicles. There are also methods of payment that aren't true credit, since you don't borrow any money. A debit card, which takes money directly from your checking account, is one. A store value card, like a gift card, is another. Debit cards do carry more risk if you're the victim of fraud, or if your card is lost or stolen. Credit cards are safer, but they are only recommended if you use them so you pay the full amount owed on time each month.
Do you know that credit cards are the most common and profitable type of credit? Well, even with bankruptcy write-offs, the credit card industry rakes in billions in profit. Now, I want each of you to ask yourself, why do I need credit? Remembering needs versus wants, what do you need right now that you can't pay for in cash or save for? Is it to pay for your daily needs, utilities, rent, food? If that's true, you need to make changes in your spending plan until it balances. The bottom line is don't put anything on a credit card that you don't already have the cash to pay for. Save your use of credit for the most important goals and pay cash for everything else.
We all know that credit card interest really adds up. A government study shows that households with credit card debt owe approximately $15,000 on their cards. The average interest rate paid on cards by these households is $2,600 per year. That's an expense that can be avoided. There are many reasons why Americans can find themselves in debt. The rising cost of living expenses, most notably food and medical costs, unbalanced budgets, past years of poor unemployment rates, and low income growth, just to name a few. Whatever the specific reason, it is advantageous to return to your spending plan and make decisions that will allow you to avoid credit card debt in the future. Just over 50% of the households that carry credit card debt report that they pay the minimum payment that is due. We call this the minimum payment trap because it keeps you in debt longer and paying more in interest.
Minimum payments on credit cards do not support anyone's goals or dreams. Minimum payments are a recipe for financial disaster. Let's look at one example. A credit card balance of just $1,000, a 17% interest rate, and a minimum payment of 2% of the balance. Assuming you don't charge anything else and you pay the minimum every month, do you know how long it will take you to pay off this $1,000? 17 years. 17 years to pay off just $1,000. And during that 17 years, you'll be paying a total of $1,590 in interest. That's more than you charged in the first place. That's the trap. Here's how the numbers work. The minimum payment is a percentage of your balance. So if you stop charging, as your balance goes down, so does your minimum payment. But the time you are in debt increases, and that time means you will pay more interest, and the credit card company makes more profit.
And it's not much better if you pay more than the minimum. Suppose you charge $3,000 on a credit card, then destroy the card so you won't charge anymore. The interest rate is 19%. You decide to pay $60 a month every month, no matter what the minimum payment is. Look at the numbers. You'll be paying for 8 years, and you'll pay almost $3,000 in interest for a loan of $3,000. Amazing, isn't it? And that's assuming you don't charge one more thing and you don't have any late fees. In 2009, there was a law passed to protect consumers called the Credit Card Accountability, Responsibility, and Disclosure Act, also known as the CARD Act. The highlights of the protections are as follows.
Interest rates on new transactions can only increase after the first year. Promotional rates must last at least 6 months.
Before any changes in terms such as interest rate can occur, issuers need to give a 45-day notice of the change. Interest rate hikes on existing balances are only allowed under certain conditions, such as a promotional rate ending, a variable rate, or a cardholder makes a late payment.
If an interest rate does increase due to late payments, the lower rate must be reinstated after 6 months of on-time payments. There are limits on universal defaults. This is the practice of raising rates due to issues with other creditors.
Consumers have a right to opt out of certain changes in terms, but would have to close their account and pay off the balance in about 5 years under the old terms. Young adults, under 21 years of age, are banned from credit cards unless they have a cosigner or can show proof of income to pay off credit card debt. Also, credit card promoters need to stay 1,000 feet from a college campus if offering gifts.
Consumers have 21 days to pay their bill after the bill has been mailed or delivered. Due dates must be the same each month, and issuers cannot set arbitrary deadlines for the payments such as time of day.
No late fees can be charged for payments due on holidays or weekends or when the issuer is closed for business. The highest interest rate balance needs to be paid first.
Subprime card issuers cannot charge more than 25% of the available credit limit on fees charged to open the account. Credit card issuers must disclose how long it would take to pay off a balance if only making minimum payments, and how much the cardholder would need to pay in order for their balance to be paid off in 36 months.
Late fees are capped at $25, but can rise if the cardholder is late more than once in a 6-month period. Gift cards cannot expire before 5 years. An unused fee can be charged only after 1 year. There is no limit on the amount of the fee, but not more than 1 fee per month can be charged.
Please note, there are no caps on interest rates that creditors can charge. Business and corporate accounts are not covered by these protections. Also, credit card issuers have the right to close accounts and reduce credit limits without warning if they choose. As we close this unit, we can sum up the key to using credit wisely like this: less means more. Live on less than your income and use credit sparingly and wisely. Spending less will leave you more for your financial goals. Now let's do a quick review of how to use credit wisely and look at some debt warning signs.
Credit is borrowing money. The lower the interest rate or the shorter length of repayment time, the less expensive borrowing money will be for you. Keep vehicle loans 4 years or less to avoid owing more than it's worth. Before you use credit, ask yourself, can I wait, save, and pay cash? Will using credit help me reach my financial goals? Will the thing I'm buying on credit have resale value or useful life when I've paid off the loan? Avoid the minimum payment trap on credit cards, and be careful when using home equity credit. Don't put your home in jeopardy.
So it's important to know and stay alert to signs that you may be getting into debt trouble. We're creatures of habit and we can be tempted. Despite our best intentions, debt can creep back up on us. An emergency fund and enough insurance can protect against debt once you have a balanced spending plan. But be on guard. Here are some warning signs that you may be getting into trouble. An unbalanced spending plan, worrying about your debt or your financial situation, using credit to fund simple living expenses. If you're carrying any credit card balances, you may have a debt problem. Making the minimum monthly payments on credit cards is a definite debt warning sign. Paying off one card with another is a bad sign. And finally, having no emergency fund is a warning sign. The main thing is just to be aware and on guard against debt. And no matter what, don't be embarrassed to get help.